In the world of business, knowledge is power. This rings especially true when it comes to your finances. Understanding your financial position is crucial for making informed decisions and achieving success. This is where the accounting cycle comes in. Think of it as a financial GPS, guiding you through the complex world of business transactions. By mastering this cycle, you gain a clear understanding of your company's financial health, allowing you to make strategic decisions that drive profitability and growth. Whether you're an accounting student, entrepreneur, or employee, the accounting cycle provides a structured framework for tracking and analyzing a company's financial data. It's a systematic process that transforms raw financial information into meaningful insights, empowering you to make informed decisions about your business. From tracking sales and expenses to managing assets and liabilities, the accounting cycle provides a comprehensive view of your financial standing. It allows you to identify trends, spot potential problems, and seize growth opportunities. In essence, mastering the accounting cycle is akin to having a financial superpower, giving you the ability to navigate the financial landscape with confidence and clarity. Before we delve into the intricacies of the accounting cycle, it's essential to grasp the fundamental concept of a transaction. In simplest terms, a transaction is any event that involves an exchange of value in your business. It's the lifeblood of your financial operations, representing the flow of money in and out of your company. Imagine you're running a bakery. Every sale you make, every ingredient you purchase, every utility bill you pay, these are all examples of transactions. Each transaction, no matter how big or small, leaves a footprint on your financial standing. Buying flour for your cakes? That's a transaction. Selling a dozen cupcakes? That's another transaction. Paying your electricity bill? You guessed it, another transaction. By accurately recording and categorizing these transactions, you create a comprehensive record of your business's financial activities. Now that we understand what transactions are, let's explore how they're organized and recorded using accounts and the double entry system. Accounts are like storage containers for your financial information, each dedicated to a specific type of transaction. For instance, you'll have accounts for assets, things your business owns like cash, inventory, or equipment liabilities, which are debts your business owes, like loans or unpaid bills, and equity, the owner's stake in the business. Each transaction will affect at least two accounts, reflecting the dual impact of every financial event. This is where the double entry system comes into play. The double entry system is a fundamental principle in accounting that ensures the accounting equation. Assets equal liabilities plus equity always remains balanced. Every transaction is recorded twice, once as a debit and once as a credit. Debits increase asset accounts and decrease liability and equity accounts. Conversely, credits increase liability and equity accounts and decrease asset accounts. Let's say you sell a cake for $50 in cash. This transaction increases your cash account, which is an asset, and your sales revenue account, which is equity. You would debit your cash account by $50 and credit your sales revenue account by $50. This ensures that the accounting equation remains balanced, with both sides increasing by the same amount. Now that we've covered the basics, let's dive into the heart of the matter, the 7 steps of the accounting cycle. These steps provide a clear roadmap for transforming raw financial data into meaningful financial statements. 1. Source documents. This is where it all begins. Source documents are the original records of your transactions, like receipts, invoices, and bank statements. 2. Journals. In this step, you'll record your transactions in chronological order in a journal. Purchases journal, sales journal, returns inward journal, returns outward journal, cash book, petty cash book, or general journal. This process is called journalizing. 3. Ledgers. From the journals, transactions are transferred to individual account ledgers, providing a running balance for each account. This process is known as posting. 4. Trial balance. This step involves creating a list of all account balances to ensure that debits and credits are equal. Errors found are corrected with general journal, suspense account, control accounts, bank reconciliation statements, draft profit and revised profit statements. 5. Income statement. This crucial financial statement summarizes your revenues and expenses over a specific period, determining your net profit or loss. 6. Balance sheet. This statement provides a snapshot of your business's financial position at a specific point in time, listing your assets, liabilities, and equity. 7. Cash flow statement. This statement tracks the movement of cash in and out of your business, providing insights into your operating, investing, and financing activities. Section 5, Step-by-Step Guide, Navigating the Accounting Cycle. Let's break down each step of the accounting cycle with clear definitions and simple examples. First, we have source documents. These are the bedrock of your financial records, providing evidence of every transaction. They can be physical documents like receipts and invoices or electronic records like bank statements. For example, when you buy ingredients for your bakery, you receive a receipt. This receipt is a source document that proves the purchase was made. Next up are journals. In this step, you'll record your transactions chronologically in a journal. Each journal entry will include the date, accounts affected, debit and credit amounts, and a brief description of the transaction. For instance, you purchase flour for $100 on credit. This transaction would be recorded in your purchases journal with a debit to the purchases account and a credit to the accounts payable account. Then we have ledgers. From the journals, transactions are then transferred to individual account ledgers. This provides a running balance for each account, allowing you to track the financial position of each specific area of your business. For example, the $100 purchase of flour on credit would be posted to both the purchases ledger, increasing the balance, and the accounts payable ledger, also increasing the balance. Following that, we have the trial balance. This step involves creating a list of all your account balances from the ledgers. The purpose of the trial balance is to ensure that the total debits equal the total credits, verifying the accuracy of your bookkeeping. For instance, your trial balance would list all your asset, liability, and equity accounts with their respective debit or credit balances. If the total debits and credits don't match, it indicates an error in your bookkeeping that needs to be investigated and corrected. Next is the income statement. The income statement, also known as the profit and loss statement, summarizes your revenues and expenses over a specific period, such as a month, quarter, or year. It reveals whether your business generated a profit or incurred a loss during that period. For example, your bakery's income statement would show your total sales revenue from selling cakes and pastries, minus the cost of goods sold, like ingredients, and operating expenses such as rent and utilities. The resulting figure is your net income or net loss. Then we have the balance sheet. The balance sheet provides a snapshot of your business's financial position at a specific point in time. It lists your assets, what you own, liabilities, what you owe, and equity, the owner's stake in the business. For instance, your bakery's balance sheet would list your assets such as cash, inventory, and equipment, alongside your liabilities, like loans and accounts payable. The difference between your assets and liabilities represents your equity. Finally, there's the cash flow statement. This statement tracks the movement of cash in and out of your business during a specific period. It provides insights into your operating activities, cash from sales and payments for expenses, investing activities, cash used for purchasing assets, and financing activities, cash from loans or investments. For example, your bakery's cash flow statement would show the cash inflow from selling cakes, the cash outflow from buying ingredients and paying rent, and any cash flow from loans or investments. Section 6. The importance of each step, connecting the dots. Each step in the accounting cycle plays a vital role in painting a complete picture of your business's financial health. Source documents. These provide the foundation for accurate financial reporting. Without reliable source documents, the rest of the accounting cycle is built on shaky ground, journals and ledgers. These steps ensure that every transaction is recorded and categorized correctly, creating an organized and auditable trail of your financial activities. Trial balance. This step acts as a checkpoint, allowing you to catch and correct errors before they snowball into bigger problems. Income statement, balance sheet, and cash flow statement. These three key financial statements provide different but interconnected perspectives on your business's performance, profitability, and financial position. By implementing the principles of the accounting cycle, even those with limited accounting knowledge can gain a firm grasp of their financial standing and make smarter decisions for their businesses.